when you go by your use, let's go with eligibility first. First of all, how many people here have been deployed over, in peacetime, over 180 days? Raise your hand. Okay, 1, 2, 3, 4, 5. During peacetime, which we're not in peacetime. Have you been deployed more than 90 days during wartime, which is, that's where considered. 90 days activation, deployment. Okay, so 90 days in a war, if you, Iraq, Afghanistan, in that situation, you automatically get the VA benefits. If you get activated and it's considered peacetime, say you get deployed to Germany or something like that, in that region, it's 181 days. If you've been in the reserves more than 6 years, then you automatically are eligible for that. How many people have been here more than 6 years? Okay. Some people are almost there, right? Hopefully. We talked to the Navy this morning. There are some people there 4 or 5 years, so they have 1 more year before they're eligible, unless they get deployed within that time period. So those are the 3 things. 90 days combat, peacetime 181 days, or 6 years in the reserve or the guard, okay, to get the eligibility. Once you get activated and you come off activation, you have to have a DD-214, and that's going to show your activation. That's going to show you, you're going to need that to be eligible to get that VA loan. Now, if I go in to go buy a house like I did my first house, no VA loan, you have to put down 20% to avoid what's called primary mortgage insurance. Mortgage insurance, or PMI. The reason why you have to pay that is because the bank, just in case you default on that loan, they want to know that they're going to get covered. So you have to pay 20% of that mortgage. So for example, your house is $400,000 you're going to purchase. You got to come up with $80,000. But guess what? If you got the VA loan, you don't have to come up with 20%. That 20% is waived. Not only that is waived, the other person that has to pay 20%, say they only have 5% to pay down or 10%, well, they still have to pay what's the mortgage insurance. So that means every single month, what I was doing in '94, even though I was eligible, which I didn't know, every single month I was paying that mortgage insurance, and that goes to the bank, and it doesn't pay down your interest. So basically, you're just throwing money away, okay? Pretty much. So with your VA benefits, you're avoiding paying that mortgage insurance. The other thing with the VA, you don't have to come up with that down payment of 20%. Your mortgage rate is a lot better than a conventional loan. So you're more competitive. So you're getting a better rate, which in turn, if you're getting a better rate, that means you're saving more money in your pocket. Okay? So in '94, I lost out basically by using a conventional loan, not using my VA loan. So